Good morning and welcome. I'm Kristen Ellertson, Senior Account Executive in the Sikich Media Relations practice that works with public pensions and the host for this morning's webinar. I'm happy to report that attendees can receive CPE credit. Just complete the survey at the end of this webinar with the 3 code words on slides that we'll call out throughout the presentation. Also, we invite questions at any time. Just type them in the provided box and we'll respond at the end of the presentation. If you are having trouble with audio, please let us know. Controlling your other post-employment benefit story, how employers and pension plans can explain OPEB liabilities to media and taxpayers. When GASB statements 74 and 75 kick into action at various times during the next 2 years, they may incite headlines like this: Metropolis hikes property taxes to record highs to fund retiree health costs. Gotham City reveals $250 million liability to fund healthcare insurance for retirees, but neighboring city owes nothing. Town of Bedrock only offers retiree health insurance to mayor and city council, and we foot the $50 million liability. This is definitely not a headline that would make Fred Flintstone say, yabba dabba do. I recognize many attendees from previous webinars. For those of you who don't know us, though, Sikich is a professional services firm that offers accounting, technology, consulting, and media relations consulting. We work for public and private organizations, including a wide variety of public pension funds. Our speakers today will be Alex Brown, Research Manager at the National Association of State Retirement Administrators, or NASRA. He has written papers on public pensions and retiree health care, as well as briefs on pension spending, hybrid retirement plans, and COLAs. Bill Hallmark, a consulting actuary at Chiron, who provides actuarial consulting for public pensions and OPEB plans. He has nearly 30 years experience and is a member of the American Academy of Actuaries. Mac Reynolds, partner in charge of Sikich Marketing and Public Relations. He counsels local governments and public pensions in messaging, media relations, and crisis communications. He's a member of the National Association of State Retirement Administrators and has spoken at conferences for the Illinois Municipal League, the Government Finance Officers Association, and the International Foundation of Employee Benefits Programs. And Fred Lance, partner in charge of Sikich Government Services. He has advised state and local government since 1983 and also served on the task force for the GASB Statement 43 OPEB guide. Fred, let's start with you.
Thank you, Kristen. Well, good morning. Hope everyone's having a great morning so far this morning. We really like doing webinars here at Sikich because we find that it gives us a great opportunity to broadcast important information to clients and prospects all across the country, and cutting down on your travel costs so you don't have to travel anywhere. So I noticed out on the East Coast there's a little bit of rain this morning, so hopefully you're not too getting bogged down in the rain and some of the bad weather, and hopefully those of you in the Midwest won't get hit by some of the weather we have coming tomorrow. So, well, Kristen, it's real tough to start thinking today about a new set of accounting and reporting rules that may not impact our other post-employment plans or our governments for another 1 to 3 years down the road, especially when right now the state and local government industry is in the midst of implementing some of the most complex pronouncements that have been issued to date with the new pension accounting and reporting standards that were issued by the Governmental Accounting Standards Board. The implementation of those standards is occurring right now and is resulting in many governments reporting significant reductions in their unrestricted net position, or in some cases, actually reporting an unrestricted net position deficit when they previously reported a positive unrestricted net position. However, the Governmental Accounting Standards Board liked what they did so much with pensions that they've applied similar accounting and reporting requirements to other post-employment benefits, or what we refer to as OPEB. What is OPEB? Well, generally, OPEB are benefits that are paid to former employees after employment, whether they're retired or terminated. So that's the key. This is something we provide to an employee after employment. They don't have to be retired. They just have to be no longer an employee, but most do qualify as retirees. The type of benefits that are provided by these OPEB plans include anything from healthcare-related benefits, such as medical, dental, vision, or hearing benefits, regardless of whether those benefits are provided by the employer or provided through a pension plan. We're still going to consider those to be OPEB benefits. OPEB benefits can also include life insurance, disability benefits, and long-term care benefits, unless those benefits are provided through a pension plan. If those benefits are provided through a pension plan, then these are considered pension benefits and not OPEB benefits. If, however, these benefits are provided by the employer outside of a pension plan, then they are considered OPEB benefits and would qualify for accounting and reporting under this new guidance. But regardless of the benefits provided, the focus of these pronouncements is the cost, if any, to the employer of providing these new OPEB benefits. Well, we really define cost in two different ways under these new pronouncements. And there's two types of costs that can be borne by the employer, what we call an explicit benefit cost and an implicit benefit cost. Under the implicit benefit cost, in this instance, a retiree will receive a benefit by being allowed to stay on in our plan. However, we cannot charge them an age-adjusted premium. Instead, we can only charge them a blended premium, the same that we would charge an active employee. This results in an implicit benefit to that retiree by paying that lower premium, and also results in implicit cost to the employer by paying a higher premium for its actives. We differentiate that with an explicit benefit. Under an explicit benefit, there's a direct cost that's paid by the employer. This direct cost is usually set as a set dollar amount, say a monthly dollar amount or an annual dollar amount, or perhaps as a percentage of the premium that the employer will reimburse or pay on behalf of that retiree or that former employee. Regardless of how we calculate those, the implicit or explicit, both will result in a liability or a potential liability to state and local governments. Believe it or not, the implicit subsidy is actually required in many states where they require the employer to allow the employee and the retiree to continue on in their health plan after retirement. And we do see that here in the state of Illinois, as well as a number of other states throughout the Midwest. Other post-employment benefits, like pensions, are part of the overall compensation plan that you as an employer use as an inducement to get someone to come to work for you. Therefore, the Governmental Accounting Standards Board considers the other post-employment benefit to be a benefit earned by the employee over the service life of the employee. Therefore, like pensions, the cost of these benefits should then be recognized over the service life of that employee. The cost, whether it be the implicit benefit provided or the explicit benefit provided, or a combination of the two, takes into account also any special funding situations. A special funding situation could arise when another entity, whether it's a government or a non-government, is making payments or contributions on behalf of someone else's employees. So we call that a non-employer contributing entity when they're making contributions on behalf of an entity that they are not part of their employees. Now, we don't want to confuse OPEB with a special termination benefit. A special termination benefit, on the other hand, is defined by GASB Statement 47. A special termination benefit is similar to OPEB in terms of providing benefits to retirees or terminated employees. However, there's a primary difference between OPEB, which is part of an ongoing compensation package, whereas a termination benefit is generally an offer made by the employer for a specific period of time to encourage employees to retire before their normal time of retirement. These benefits then are used as an inducement to get an employee to leave our employment prior to their time. Since there's no service life remaining to amortize these costs over, the cost of a special termination benefit is generally accrued when the employee gives us notice that they will retire early and take that benefit. Also, another point of confusion are sick leave conversions. Sick leave conversions are not OPEB, but rather just a compensated absence as defined by GASB Statement number 16. So these are the basic definitions of what the new OPEB standards apply to or don't apply to. Why are we changing the accounting and reporting for these benefits now? Well, we now have accrual-based financial statements for governments at the entity-wide level. Under the accrual basis of accounting, we recognize the cost of employees' salaries and benefits as they're earned by the employees, regardless of when those benefits are funded or paid by the employer. The Governmental Accounting Standards Board likes what they've done with pensions so much that they're now going to ask us to apply similar guidance to accounting and financial reporting for other post-employment benefits. As I noted a minute ago, most governments are just now implementing the GASB pension standards, starting with the fiscal years ended June 30th, 2015, and we're seeing a large number of governments starting to report these unrestricted net position deficits. We expect the new OPEB standards to have a similar effect, especially for governments that provide explicit benefits. Similar to pension standards, we have two new OPEB standards now, both of which were issued this last summer. It was a very, very busy summer for the Governmental Accounting Standards Board. The first pronouncement is GASB Statement number 74, Financial Reporting for Post-Employment Benefit Plans Other than Pension Plans. So just like the title sounds, this pronouncement covers accounting and financial reporting by the plan itself, whether or not that plan is administered through a separate trust. These separate OPEB reports now will require much more transparency on the cost of other post-employment benefits, including the calculation and disclosure in the notes of the financial statements of what we call a net OPEB liability. This pronouncement, Statement 74, is effective for plans for their fiscal years ending June 30th, 2017 and thereafter. If the plan does not prepare a separate report, as we're finding quite often in the industry, then the employer's annual audit report must include all the information required by GASB Statement 74. So again, if you're a single employer or local government with a single employer plan, and that plan is not in trust and there's no separate plan report or plan financial statements, the employer will need to include all this information required by Statement 74 within that employer's report. So this is what GASB calls accounting by the plan itself. What about accounting by the employer? Accounting by the employer is covered by GASB Statement number 75. GASB Statement 75, titled Accounting and Financial Reporting by Employers for Post-Employment Benefits Other than Pension Benefits, will now require employers to recognize the cost of OPEB benefits as they're earned over the service life of the employee, again, regardless of when the employer will fund these benefits. So we'd like to say in the industry that GASB has again divorced the funding of OPEB from the accounting for OPEB, just as they did for pensions. This new method that they've come up with applies to accrual-based financial statements of the employer and requires the employer or a non-contributing employer under a special funding situation to record an expense and a liability as the benefits are earned by the employee, which will greatly accelerate our expense recognition and our liability recognition for these benefits. This pronouncement in all likelihood will have a significant impact on any employer that provides explicit benefits. The advanced expense and liability recognition, coupled with that lack of advanced funding of OPEB benefits, as Alex will expound upon with his research in just a moment, may result in an impact greater than what we are seeing today from the implementation of the pension standards. While we are certainly seeing some net pension assets being recorded by state and local governments today, we don't anticipate seeing many, if any, net OPEB assets being reported in the future. GASB Statement 75 is effective for fiscal years ending June 30th, 2018 and thereafter. While early implementation is allowed and encouraged, we really do not anticipate many governments wanting to be the first on their block to implement due to the negative impact it might have on the unrestricted net position. The goal of the GASB in developing these pronouncements is to provide more accurate information related to OPEB plans and the cost of OPEB plans to the employer and ultimately to the taxpayer. The recording of the liabilities on the face of the financial statements, along with significantly expanded note disclosures and required supplementary information, will provide greater transparency regarding these overall costs. As Bill will note, we will use a similar methodology and actuarial cost method for calculating the OPEB liabilities, resulting in greater consistency among and between governments, regardless of what state they might be within. As Matt will note, this new consistency and transparency may raise issues for governments that voluntarily provide explicit benefits and do not advance fund the cost of these benefits. This is all due now to the need to measure the cost of employee benefits, as those benefits are earned by the employee to be consistent with pensions. With that, I'll turn it back over to Kristen now to lead into our next presentation.
Thanks, Fred. This slide contains the first of 3 code words required for CPE credit, OPEB. This stands for Other Post-Employment Benefits. Please ensure you view the word and write it down, as we will not be able to give this word to you after the slide has passed. You will be prompted to type this word at the end of the presentation. Per CPE guidelines, each code word will appear on your screen for about 1 minute. In the meantime, please continue to type your questions in the provided box. We will address them at the end of the presentation. To better understand.
Thanks, Kristen. I'm Alex Brown, Research Manager with NASRA. Just by way of background, NASRA is the professional association for the directors of the nation's largest state and statewide public employee retirement systems. Some of those systems have direct responsibility for the administration of retiree health benefits as well as pension benefits. And in response to this, NASRA Research Office has produced some summary level information on state and local retiree healthcare finances, including assets and liabilities, funding practices, and programmatic changes to retiree health benefit offerings. So I'm going to use my time before you this morning to provide a high-level overview of our analysis, most of which is available in an issue brief that we co-authored with the Center for State and Local Government Excellence, titled Spotlight on Retiree Health Benefits for State and Local Employees in 2014, in which we looked at state and local OPEB finances using FY13 data. First, a few high-level findings from our study. The state and local retiree health care landscape is diverse, and benefit offerings run a wide range from states with fully or partially subsidized retiree premiums to others where the benefit amount is tied to a fixed dollar contribution, a periodic contribution to an individual defined contribution account, or small subsidies. There are some similarities among plans too, chiefly the basic structure in which the employer provided insurance is the primary insurance until such time as the retiree reaches the age of eligibility for Medicare and it becomes secondary to that program. This simplification, of course, glosses over some of the important individual characteristics of health plans, but generally this characterization provides a good starting point for mapping the state OPEB community. Some states face considerable OPEB unfunded liabilities. Collectively, unfunded liabilities for OPEB benefits were nearly $500 billion as of FY13, a figure that's relatively unchanged from that of the prior year. A disproportionate share of this burden is carried by a relative few states. Most state OPEB liabilities are not funded by assets. However, in recent years, more states have begun to set aside more funds to pay for future OPEB benefits. Similar to the share of unfunded liabilities, the overwhelming majority of OPEB assets are held by just a few states. Finally, unlike pension benefits, which generally enjoy a higher standard of legal protection, OPEB benefits are more flexible and subject to the influence of a number of factors, such as legislative benefit changes and legal rulings, the plan's actuarial experience versus key actuarial assumptions, and of course any factor that affects the cost of medical services moving forward. The following are some factors that can influence the growth of OPEB liabilities. This is not an exhaustive list. There are many factors besides those that I've listed. Most states fund OPEB benefits on a pay-as-you-go basis, meaning retiree health expenses are funded as an annual operating expense. Lately, more states have begun to accumulate dedicated OPEB assets. Pre-funding OPEB benefits by setting aside assets in an irrevocable trust can defray employer costs by raising investment income to help fund the cost of future benefits. As I mentioned, state OPEB plans rely on assumptions, including but not limited to the investment return assumption if the plan has assets and the assumed rate of medical inflation. To the extent that the experience differs from what is assumed, it can impose a disproportionate impact on the costs of the plan. And finally, as I mentioned, of course, any factor that affects the cost or the future cost of health insurance will likely reflect in costs for state OPEB plans as well. So this is a chart from our brief, and it displays the unfunded OPEB liabilities for plans covering state and local workers in each state as of FY13. Each state is represented by one bar in this chart. As I mentioned, in aggregate, state OPEB unfunded liabilities as of FY13 are approximately $500 billion, more or less unchanged from the prior year. The average state OPEB unfunded liability in FY13 was $10 billion, and the median was $2 billion. This difference reflects the fact that the share of OPEB unfunded liability attributable to each state varies considerably. And over 75% aggregate unfunded liability is carried by the top 10 states that I've identified on this slide from left: New York, California, New Jersey, Texas, Illinois, North Carolina, Connecticut, Georgia, Massachusetts, and Ohio. The wide range in unfunded liabilities largely reflects the variation in coverage and generosity of benefits among states. As an example of this, states that subsidize all or most of retiree healthcare premiums may face greater costs since the benefit is wholly or partly subject to the inflation in the cost for medical services, at least to a higher degree than states that offer retirees a fixed dollar contribution or a defined contribution health benefit account. As I mentioned, states differ with respect to funding OPEB funding strategy. Some states choose to pre-fund benefits and others fund on a pay-as-you-go basis. This chart plots the funding effort as measured by the share of the annual required contribution, or ARC, paid in aggregate for OPEB plans covering state and local workers in FY13 in each state. The ARC is, of course, a required reporting disclosure required by the outgoing GASB standards. It's eliminated as a required disclosure under the new standards. And furthermore, not all states fund their plans on the basis of the ARC, which is, of course, defined by its component parts, namely an amount required to fund the cost of benefits earned that year, and an amount to pay or amortize any unfunded liability in accordance with the plan's amortization schedule. Effectively, states that fund on a pay-as-you-go basis are not paying the unfunded liability portion of the ARC. So with that said, each state on this chart is represented by a bubble, and the size of the bubble is roughly proportionate to the size of the aggregate state OPEB unfunded liability. The average percentage of ARC contributed in FY13 was 55%, and the weighted average was 46%. This difference is accounted for by the fact that generally those states that funded at a level at or near the ARC experienced the lowest OPEB costs, while states with larger ARCs were among the lowest contributors. So earlier I mentioned that more states are setting aside assets to pre-fund OPEB benefits. As of the publication of our report, we counted 33 states holding approximately $33 billion in OPEB assets. This continued an increase in the number of states holding assets observed over the past 3 years. Despite the nominal increase, nearly half of all reported OPEB assets are held by just one state, the state of Ohio. And this chart provides a good perspective on the relative size of state OPEB assets, where in Ohio, which is indicated in orange, holds much more than the next highest states and nearly half of the total. As of FY13, with $16 billion in OPEB assets, Ohio's cumulative OPEB funded ratio is nearly 55%, which is among the highest of any state in the country. Another in a list of factors that we examined were key actuarial assumptions used by state OPEB plans. If a plan utilizes pre-funding, the investment return assumption, which serves as the discount rate used to derive the present value of accrued liabilities, becomes a very important figure. As of FY13, the median OPEB investment return assumption was 4.9%. Another important assumption is the assumed rate of medical cost inflation. Most states adopt a rate that reflects a short-term assumption that declines gradually before leveling off at a long-term assumption. In FY13, the median short-term medical inflation assumption was 7.3%, and the median long-term rate was 5%. I know our next presenter, Bill Hallmark, will delve into these issues in greater detail, so I'll leave it at that. States have a number of policy tools at their disposal to rein in the cost of OPEB benefits. Many states are not contractually obligated to provide retiree health benefits at all, and some states have limited legal protections that permit modifications, even to accrued benefits. This is not the case in every state, however, as the legal protections for retiree health benefits in some states are inviolable. The most notable example is Illinois, whose Supreme Court in 2014 rejected a 2012 law requiring retirees to begin contributing towards the cost of their health benefits where previously no contribution had been required. At a minimum, most states have the ability to modify retiree health benefits prospectively. Possible benefit modifications include, but are not limited to, decreasing the premium subsidy, shifting from a premium subsidy to fixed contribution benefit, increasing copays and deductibles, and increasing eligibility requirements for full benefits. And finally, I'll just briefly mention another potential strategy that could be employed by state and local governments is to avail themselves of opportunities to shift costs to public or private health insurance exchanges enabled by the Affordable Care Act, which would effectively permit them to continue to offer access to benefits while offloading some of the direct costs. This may be a more plausible option in some states than others, but it's possible that this could give states another option for providing health benefits to pre-Medicare retirees, where previously these folks would have received a state-subsidized benefit. This is likely to develop over time as a strategy as some of the details of the ACA continue to develop. Just one point briefly on access, and this chart is included in a prior version of our issue brief on healthcare costs. This chart illustrates the percentage of state government units offering retiree health insurance from FY08 to FY13. Data are offered by the HHS Medical Panel Expenditure Survey and are presented for two groups, retirees under 65, designated by the white line, and retirees 65 and over in orange. Since FY08, the percentage of state government units offering health insurance to both groups of retirees has declined 50% for both in FY08 to just under 75% for pre-Medicare retirees and just under 65% for retirees 65 and older in FY13. And I will just quickly conclude with some final observations. Again, state OPEB liabilities remained relatively stable in FY13, though for some states the burden is much more significant than others. More states are beginning to pre-fund OPEB benefits, though again, just a small amount of states hold the overwhelming majority of OPEB assets. States continue to address the cost of OPEB benefits and costs chiefly through benefit reductions and to the extent permitted by individual state law. And finally, new GASB standards will fundamentally change OPEB reporting requirements, and I know our next presenter will elaborate on that point.
Thanks, Alex. Let's switch over to Bill Hallmark for the actuary's perspective.
Thanks, Kristen. I just wanted to touch on a few of the key GASB changes from an actuarial perspective. The first key change to note is that all calculations now have to be performed as of the measurement date used for the financial statements. So if the valuation date is earlier, and it can be up to 24 months earlier for the plan or 30 months earlier for the employer, the liability will need to be projected to the measurement date. Some plans already do this, but under GASB 45, there may be a lag. In addition, in order to improve comparability, GASB has designated a single actuarial cost method for the measurement of the liability, the entry-age method. While this method is common, there are many OPEB valuations that use other methods and will need to change. Also, the basis for the discount rate has changed. I'll discuss those changes in a few slides. The difference between the total OPEB liability and the assets on the measurement date, the unfunded liability, or what is now called the net OPEB liability, will be reported on the sponsor's statement of net position. This amount was previously disclosed in their notes, and a different amount was shown on the statement of net position. The immediate impact of this change will vary by employer, but could be significant. Also, employers participating in cost-sharing plans will now have to disclose their proportionate share of the net OPEB liability on their statement of net position. Since those employers probably do not currently report any liability, this change could be very significant. In addition to the net OPEB liability, unanticipated changes that have not been recognized in OPEB expense appear on the statement of net position in what are called deferred inflows and deferred outflows. We won't go into the details here, but it means that the total impact on the net position is not quite as volatile as the changes in the net OPEB liability. The annual expense reported on the sponsor's financial statements is no longer based on the annual required contribution. Instead, it will be a much more volatile amount, reflecting changes in the net OPEB liability over relatively short periods. As I mentioned earlier, the basis for the discount rate is changing. For pay-as-you-go plans, the discount rate will now be the yield on a 20-year tax-exempt general obligation bond as of the measurement date. Right now, these yields are not markedly different than discount rates currently in use, but the yield changes constantly as market conditions change. So you are likely to need to use a different discount rate every measurement date or every year. Fully pre-funded plans continue to use the long-term expected return on assets for their discount rate, but what qualifies for a fully pre-funded plan has changed, and the calculation of the blended discount rate for a partially funded plan has changed. Like pensions, OPEB plans may need to perform a crossover test to determine their discount rate. The crossover test requires a projection of benefit payments and assets for current plan members. The assets, shown in the red line on this chart, are projected with expected investment returns and future contributions intended to pay for current members. This generally means future contributions minus the normal cost of new plan members. It's important to have a formal contribution policy for this test. Otherwise, future contributions have to be inferred from historical patterns. Any projected benefit payments made before the assets run out under this test are discounted at the expected return, and any made after assets are expected to run out under this test are discounted at the bond yield. The discount rate that you use in your valuation is the single equivalent rate that produces the same present value. What's interesting here is that a commonly used annual required contribution that was based on a 30-year rolling amortization would not satisfy this test and would have to use a discount rate less than the expected return on assets. But if you have a closed amortization period, it may even be longer than 30 years and still satisfy the test. Under GASB 45, the annual OPEB expense was based on the annual required contribution. That is no longer the case. Instead, you can think of the OPEB expense as consisting of the employer portion of the benefits attributable to the current year of service, plus the interest on the net OPEB liability, plus recognition of unanticipated changes over relatively short periods. The annual required contribution generally used a relatively long amortization period, but now these changes are recognized much more quickly. Plan changes are recognized immediately, investment experience is recognized over 5 years, and other experience, including assumption changes, is recognized over the average future working life, including inactives. That means is if your actives average 10 years and you have as many inactives as actives, the average future working life would only be 5 years. Portions not recognized appear on the balance sheet as a deferred inflow or outflow. The annual OPEB expense will generally be higher and much more volatile than under current standards. The interest on the net OPEB liability will generally be higher than the typical amortization, but not all amortizations, that are used to calculate the ART, and the short recognition periods can cause wide fluctuations in the annual expense, particularly if there's a significant plan change. While not related directly to the GASB changes, many of you may be aware that the Society of Actuaries recently issued new mortality tables and new projections of mortality improvement. The good news is that we are all expected to live longer, with many more people living into their 80s and 90s. The bad news is that makes it more expensive to provide lifetime benefits. The impact of this change can vary significantly depending on your population and your current assumption. So check with your actuary on the potential impact to your plan. And while healthcare inflation trends have been relatively moderate recently, we are continuing to see trends exceed the growth in wages, GDP, and other prices. Finally, from an actuarial perspective, what should you be doing now to prepare for the implementation of these new standards? One of the most important things you can do is to review your funding strategy in light of these requirements. Transitioning from a pay-as-you-go to a pre-funding strategy can be difficult and probably needs to be done over a very long period of time, but there can be significant advantages, including improved security of benefits, investment income helping to pay for the benefits, and lower financial statement liability and expense. If you already have a pre-funding strategy, you may want to review it in the context of the crossover test to make sure the test will be satisfied, so you can use the higher discount rate based on your expected return on assets. With that, I'll turn it back to Kristen.
Thanks, Bill. This slide contains the second of 3 code words required for CPE credit. The word is GASB and stands for, as you know, Governmental Accounting Standards Board. Please ensure you view this word and write it down, as we will not be able to give this word to you after this slide has passed. You will be prompted to type this word at the end of the presentation. Per CPE guidelines, each code word will appear on your screen for about 1 minute. In the meantime, please continue to type your questions in the provided box. We will address all questions at the end of the presentation. Those rising costs that Bill described, and the likely perception that private citizens will be footing yet another public pension expense, will attract media attention. Reporters love this sort of thing, which brings us to Mac Reynolds, the partner in charge of our media relations practice.
Thanks, Kristen. State employers, municipal employers, and public pension plan directors should ask themselves 2 questions. Are you ready to be more clear in the way you report your financial obligations? And are you ready for questions about why you weren't more clear before? Because the size of these future obligations can be quite large, as Fred, Bill, and Alex described, you should be ready to face some of the same kind of media scrutiny that inadequately funded public pensions face. And along with the usual stories about pension underfunding, abuse, lack of transparency, we see headlines like these from the Wall Street Journal: the public pension funding trap, or public pension potholes in wine country paradise. And we now see stories about these other retiree benefits that are suddenly coming to light, with headlines like from Crane's Detroit Business, University of Michigan survey, local leaders concerned about retiree health care, out of Massachusetts, a story about a special town meeting asking voters to establish an OPEB trust fund. And we can foresee other headlines to come. Like Kristen described earlier, a pension crisis too. Now we owe for unfunded retiree health insurance. Or Pleasantville residents feel OPEB pain with new regulation that brings a $100 million liability. Or OPEB, a giant financial boogeyman that jumps from the closet. Those kind of mock headlines aside, though, the reality is this: GASB numbers 74 and 75 don't change a plan's financial health, but they highlight a big benefit to retirees that may surprise taxpayers. So state and municipal employers, as well as many pension plans, face a big communications challenge. How can we help reporters, smart people who majored in English, not accounting or actuarial science, understand this reporting change? How do we explain how these numbers, once buried in the document and now at the front, neither change of financial health nor reflect a poorly conceived attempt by elected officials to feather the nests of public workers without alerting taxpayers? So in our little chart, which has been taken from real reports, we see a couple of issues. The first two towns, we call them Bedrock and Mayberry, are large cities with blue-collar populations. These towns provide explicit retiree health insurance benefits, even though they are not legally required to do so. Bedrock, as you can see, is pre-funding. Mayberry is not. And as you can see, Mayberry's liability is twice that of Bedrock's. Now those two cities, along with this state that we cited in the fourth row, all have these explicit benefits. That is, they must pay all or a portion of the retiree health insurance cost. This illustrates the impact and the benefits of advanced funding, of course, but it also shows the PR problem the state will have when people start to realize that those they trusted to be good financial stewards have not been saving for a big, long, rainy day. And there's another potential media problem. Compare Bedrock with its neighbor, Bedrock Falls. Both are about the same size, with a similarly sized workforce. Bedrock Falls, however, provides an implicit benefit rather than an explicit one. As such, its per-employee obligation is just a fraction of what Bedrock must pay. And that will likely be a story in those two communities. So with those kinds of figures, as those kind of figures become more apparent in reports, reporters will ask some pretty tough questions. Among them, if OPEB benefits are part of a retiree's pension, why haven't you funded this in the past? What else does OPEB include? Why did GASB decide to change how this number is reported now? Why weren't you more transparent before? And what else should we be examining? And reporters may not be the only ones challenging state and municipal employers. It's very conceivable that the same credible experts who say public DB plans are unsustainable and unfairly burden taxpayers will turn their attention to the unfunded liabilities created by these other retiree benefits. People from credible groups like the American Enterprise Institute, academics like Joshua Rao or Robert Novi Marks, legislators who might be seeking reform, even ratings agencies who publicize their own public pension guidelines. And we'll see more editorials that challenge moves by state and local governments to try and fund retiree benefits, like this story from the Wall Street Journal. Governments are still failing to make full contributions. Public pensions are taking greater investment risk with the money they do receive. If those investments fail to pan out, the budget picture for many governments will once again be grim. Or this editorial from Forbes. If public pension plans are losing ground on their funding status in years when the market is delivering above normal returns, is there any hope? Probably not. But if there is a way to save public pension funds, it will require the two parties most responsible for the current sorry state of affairs, state politicians and government employee unions. And while such criticisms strike all involved with pensions and public retiree benefits, Illinois probably gets it the worst. Here from the Associated Press, the state of Illinois was rated the country's most troubled public pension system in a study of state-administered pension plans, retiree health care, and other post-employment benefits. Now, few of us enter a career in municipal service or DB plan management because we like the glare of a negative media spotlight. Yet many state and municipal employers will likely hurt themselves when it comes to addressing retiree benefits. They'll be too passive or too slow to respond to public criticism. Instead of playing offense, they'll have to play defense and catch up. And I think public pensions provide a case in point here. Many public pensions respond after pension viability is challenged, or they respond after questions are raised, or they respond after editorial opinions and public opinions take shape, or after ratings agencies state their cases. In truth, though, most plans have very good and important news to share. News about prudence, about minimizing costs, about long-term investing, about how they handle the taxpayers' money. So in circumstances like this, we like to point to one plan that stays in front of these stories, one that does not wait for reporters to call, but rather it goes to educate them. And that plan is the Illinois Municipal Retirement Fund. And I think state and municipal employers could do a lot worse than take a page from IMRF's Media Relations Playbook. So for those who aren't familiar with IMRF, it was created by the Illinois General Assembly in 1939 as a multi-employer pension plan covering communities across the state. It's locally funded with about 3,000 employers. It's the second largest plan in Illinois, and it's 93% funded at the end of the year, end of 2014. It does not have an OPEB obligation. But several years ago, IMRF Executive Director Lou Casiva and his board recognized the need to take control of IMRF's own brand and distinguish itself from other public pensions, particularly the state plans that were poorly funded. IMRF recognized and embraced the challenges of dealing with the media, that reporters are unfamiliar with the subject, on deadline, that reporters embrace conflict, controversy, and anything with billions of dollars associated with it. And IMRF worked to simplify the pension finance story, to keep messages simple, and develop messages that would address public concerns and effectively tell two stories. First, stories that are revolved around the importance of public pensions in general, that retirement security benefits everyone, that pensions work, that public pension policies have a long-term impact, and that public pensions support our local economies. Then we developed a set of messages specific to the Illinois Municipal Retirement Fund. IMRF is a good role model. It is locally funded. It is independently managed. It is focused on the long term. Equipped with those messages, we developed an active, measurable PR plan to deliver them. We trained media spokespeople. We identified every single reporter in the category who covered public pensions, whether they were print, broadcast, online, bloggers, everyone. Whenever we saw a mistake, we corrected it. We looked for chances to provide even the briefest commentary on what was happening with public pensions, and we pursued much larger stories through editorial board meetings across the state. We even developed a program to for public speaking to address community groups. And over time, those efforts paid off. As a result of the program's consistent proactive media relations work, we've seen that message get through to reporters and in turn to the public. Here are a handful of headlines from the Chicago Tribune. The Illinois Municipal Retirement Fund sets a good example. From the Associated Press, not all Illinois pension funds are in serious financial trouble. IMRF is not part of the underfunded state system. How do they do it? Officials say it's a combination of good planning and wise investing. And this from the Better Government Association and Springfield, Illinois' State Journal Register. IMRF acts as a shining example of how the often maligned traditional defined benefit plan can work, provided it's properly funded by employees in government, pursuing a sound investment approach, and dedicated to weeding out questionable practices and corruption. Now, some of you in charge of communications may be doing much of this already. If so, it's just a matter of crafting and delivering a new set of OPEB-related messages. But for employers and plans who don't have a programmed proactive public relations effort that addresses other retiree benefits, or haven't needed one in the past, we'd like to show how to apply this IMRF example to media interest in OPEB. First, you should prepare to craft and control your own GASB story. That means identify the appropriate audiences, media, taxpayers, elected officials, understand what they want and what they need to hear about whether OPEB is pre-funded, costs are always included in the annual reports, then develop a media relations strategy that delivers your messages and addresses your audience needs. Develop that message using words the general public can understand. Address the important questions. What are your OPEB funding strategies? What plans do you have to deal with these costs? How will GASB 74 or 75 affect the plan or not affect the plan? How will it affect the employer's financial statements? And don't wait for reporters to call. Doing that will invite many to draw inaccurate conclusions, write their stories in advance, and ask you for a simply short comment once the story is finished. Then, media train your spokespeople, develop the proper press materials, keep them devoid of jargon as I mentioned before, be proactive, pursue reporters, offer them introductory sessions into OPEB 101, develop your stories, whether it's news releases, op-eds, correct errors, whether the error was made by the reporter or by a public official. Look for opportunities to tell that story. Capitalize on what might be happening in national news. Look at opportunities through public service efforts. Look at retiree profiles. Look for things like National Save for Retirement Week and stories you can develop around there. Prepare to accept the bitter with the sweet. That's part and parcel to dealing with media. Finally, don't treat this as a one and done. Stories about the financial stress on states, cities, and taxpayers that other retiree benefits create will be around for a long while. And if the employer, state or municipal, is already in a financial bind, these stories and editorials could challenge fairness and sustainability of these benefits, just like many stories do now with pensions. So don't sit idle. Become a visible, accessible expert on the subject and own your own story. My opinion, it's the single best way for your story to be told clearly, concisely, accurately, and with the proper context.
Thanks, Mac. This slide contains the last of 3 code words required to receive CPE credit. The word is pensions. Please ensure you've used it down, as we will not be able to give you this word after the slide has passed. You will be prompted to type this word at the end of the presentation. Per CPE guidelines, this code word will appear on your screen for about 1 minute. In the meantime, please continue to type your questions in the provided box. We'll address these questions next.
I think Alex has the first one.
I'd like to address one question that I've received. Question says that when I'm discussing the median OPEB investment return assumption, which I identified as 4.9%, question asks whether this includes the assumption for just those plans that are pre-funding OPEB benefits, or if it also includes those plans that are not pre-funding, that are funding on a pay-as-you-go basis. The asker of this question asks me to identify the median return assumption for those who are currently fully funding OPEB benefits only. The answer to that question is that in the publication that I spoke from, the median investment return assumption figure is inclusive of all plans. We don't parse it out between plans that are pre-funding and plans that are pay-as-you-go. I would be happy to disaggregate that data, though, and come up with a figure for both in response to that question, and perhaps I can do that after the presentation is over offline. Furthermore, I think it's a good point and something that we should consider in our future work in this area, is to provide some specification to that figure.
Okay, thank you, Alex. Now we have a question for Mac Reynolds.
Yeah, so somebody asked if we really should be reaching out to reporters, if that's just asking for trouble, which is a fair question. You can sit back and do nothing, and perhaps your OPEB obligation is reasonably well funded, and it's possible that these sorts of stories just won't interest media or taxpayers in the area. But in my years of doing this, I've faced a lot of similar circumstances, and 8 out of 10 times at least, you're going to be better off taking the initiative. To educate reporters in advance, provide the proper context, and become a ready, willing, and able resource for them. Otherwise, it's a very tricky subject and easy for them to get it wrong.
Thank you, Matt. We now have another question for Fred Lands.
Thank you, Kristen. The question that came in is, we're with an authority, and the authority reports as what we call a business type activity model. So it reports as a single fund, and they present comparative financial statements as part of their financial statement presentation. The question is, with comparative financial statements, when they go to implement GASB statement number 75 on accounting and financial reporting for OPEB by the employers, do they need to restate the prior year comparative presentation, or would they just present the prior period adjustment or the change in accounting principle flowing through the current fiscal year information? Outstanding question, and one that we've been posed with related to pensions as well, with many governments implementing GASB Statement 68 today. The answer, as developed by the American Institute of Certified Public Accountants along with the Governmental Accounting Standards Board, is that when you do present comparative financial statements, to the extent possible, you should restate the earliest period that is presented. So if the required implementation date is June 30th of 2018, and you present your financial statements for June 30th, 2018 on a comparative basis, meaning you have both financial statements as of June 30th, 2018 and June 30th, 2017, you should go back and restate those June 30th, 2017 figures for this new change now brought about by GASB Statement 75, if possible. What that might require you to do is to actually accelerate your implementation methodology by 1 year, so that the plan would actually implement as of June 30th, 2016, as opposed to June 30th, 2017. Then you would have information available for the employer as of June 30th, 2017. So therefore, at June 30th, 2018, you'd have 2 years of data available for the employer instead of just the 1 year. That would be your best scenario for an implementation of your comparative financial statements. Alternatively, if you did not have if you could not present the information on a comparative basis, then you could still present comparative financial statements. However, that becomes a little more complex. Your 2018 financial statements would be in accordance with GASB Statement 75, while your 2017 financial statements would still be in accordance with the old GASB Statement 45 on employer accounting and reporting for OPEB. You would need to differentiate between those two in your notes of financial statements, and also then carry 2 sets of disclosures and 2 sets of required supplementary information, one in accordance with GASB Statement 75 and one in accordance with GASB Statement 45. We certainly hope that you all aren't in this situation, and if you do have comparative financial statements, you can find that first alternative to be a better alternative for the implementation.
It looks like we also have a question for Bill Hallmark.
Yeah, so the question I have is about the market yields for municipal bonds, where I'm showing 3.8%, and someone looked at another site and saw 2.9%. I'm showing the 20-year GO bond index, because it's restricted to general obligation bonds with an average rating of AA, which I think is really the definition that GASB laid out. You can get much lower discount rates if you're looking only at revenue bonds or higher quality bonds. So the definition of the municipal bond you look at may make a difference. But I think in general, pension plans have switched to use something like the Go Bond Index.
Bill, this is Fred Lance. That's an excellent point and an excellent response to that question. One issue that we found in implementing GASB Statement 68 on pensions recently is the date that the actuary chooses to use that bond rate as of. Generally, the requirement is that you should use the bond rate that is as close to the measurement date of when you're measuring that liability. So what some folks might be doing is comparing that to the current bond rate or the current yield rate that we see for a AA-rated GEO index. So it's real important for folks to remind that when you do the calculation, you want to pull that bond rate as of the measurement date or as close to the measurement date as possible.
Yeah, and that's a great point because the Go Bond Index is published weekly, so you won't always get a rate on your measurement date. So you should be selecting the one closest to the measurement date.
All right, we got one more. So when should we start communications efforts? That's a good question. I think it depends on where you are and when things start to kick into effect in your area, but I'd start soon to develop the messages and answers to what you think will be those tough questions that you might get either from media or from taxpayers or some of those special interest groups I mentioned earlier. Then I'd polish that content and train to talk to media. Then once I felt comfortable, once I felt like I had my story down, then I began to contact reporters and say, hey, there's something important coming with other retiree benefits, and I'd like to explain it to you and your readers and viewers or listeners what it's going to mean so that when this takes effect, you, who's the reporter in charge of this sort of thing, is going to be well equipped to tell your story to your constituents.
All right. Thank you, Mac. Any other questions?
Oh, I do have one last one that came in, and actually I think this might be for Bill, even though it was addressed to me. So Bill, we'll see how we can both do on this one. I'm guessing this is probably from a smaller unit of government, and they asked, under GASB Statement 45, paragraph 13A, and I'm impressed that they know that paragraph reference. It's very, very good. There was an exception on the implicit subsidy made for governments that participated in what's called a community-rated plan. And with the community-rated plan, it gave the actuary the option of using a blended premium instead of an age-adjusted premium as part of the calculation of that overall OPEB liability under GASB Statement 45. So some governments were able to not have to calculate and record an implicit subsidy through the use of this community-rated plan. Is that exception still allowed under GASB Statement 75 now, or has the use of a community-rated plan or calculation of that been closed now with Statement 75? Bill, did you want to address that?
Sure, I'll take a shot. The GASB has followed a recent change in actuarial standards of practice that says that you should value an implicit subsidy based on the structure of the essentially a health plan that is sharing costs across different employers. And so no, you don't get the same exception that you had in the past to avoid calculating the implicit subsidy.
Great. I think that's a very important point, Bill, for a lot of these smaller governments in the country who might in the past have used that community-rated plan exception, where they're now going to need to hire an actuary and actually go through the calculation and look at recording a liability just related to that overall implicit subsidy. So thank you very much for that answer, Bill.
Thank you, Bill, and thank you everyone for joining us today for the webinar this morning. We hope you found this information useful and understand more about OPEB. I know we're just about out of time, but you do see the contact information for two of our speakers on the screen, and I'll also switch to the two Sikich speakers in a moment. So if you have any further questions, please feel free to contact them directly, and they'll do the best to help you as they can. So thank you again for joining us today, and we hope you have a great rest of your day.